What I like here is that the book The Fourth Turning came out, what is it, like in 1997, and talked about the idea that all kinds of changes might happen economically on the macro scale and socially, and that it would open up. It took the world by storm, especially the Wall Street folks and the high street folks, because well, there are trades that can happen in volatility events. So all kinds of things that can occur. So the high ages, the gold, the dot-com bubble, the global financial crisis, the and the rise of populism that we have right now. And so what I love about markets is that before I felt like was completely hopeless. There was never any point in reading the news. The more I knew about anything, the worse everything was. And now I feel like, hey, there's an opportunity for me to do something good for me and my family. So,
Yeah, I'm glad you bring that up. I feel like early on, especially when I was much younger, my parents looked at the stock market like this, it was too risky of a thing to really get involved in. And then the further down I got down the path of trading and investing and understanding markets, I'm realizing it's really risk and volatility that we're most interested in. That's where the opportunities end up showing up. So yeah, I'm always interested in movement, and it's kind of boring right now too.
well, see, that's what I wanted to talk about first here, the boringness of it, because you brought this up a couple of times, where it's when volatility is low that you have to watch out. When the sky is, seems to be falling and people are running around with their hair on fire, and every other story on CNBC is about how the market's going to crash. That's usually the time where okay, everything's perfectly fine. Or put it another way, if Jim Cramer is telling me I should be worried, I'm not worried. Um, but when volatility is low, but then there's certain signs that are showing up that shows, hey, there might be some sort of problem coming down the pike. That's where I worry, and that's where I feel like I am right now. So that's why I want to talk about the first story, which I mean, it's going to be like we've been talking about again and again for weeks, which is this rise in the US dollar. So the dollar has just been was soaring, and now like it's basically at a higher high, and we are in the situation where I'm I would have hoped to see the dollar retrace from the DXY pretty sharply. Let me just pull up my chart here.
And it almost did that.
It almost did, and then it decided it decided not to. On the what is it? CPI went up a little bit, and then central banks all around the world started cutting like crazy. Some of them doing double cuts, some of them hinting at double cuts. And so we have here the chart of the DXY. We have this channel I've been talking about, where we basically been moving up and to the right since the global financial crisis in 2008, 2009, and we get these plateaus, right? We get these plateaus, it moves up, a new plateau, and it moves up, and then a new plateau. What I didn't really realize, and I should spend more time, Mike, I think, looking at the dollar. I don't know why I don't,
You're
but
you're more of an observer than I am. I mean, we brought the dollar up quite a bit on our show here, but um, yeah, I think one even more a more recent break here was this break at the on the 22nd of November when the dollar pushed above 107.50. We've been stuck in this little range here between 100 and 107 since all the way back since January 2023. So what I find pretty compelling here is this new break, and then of course the potential impact against the other competing currencies that make up the Dixie. Of course, China being one of the components there.
yeah, so we have this thing here where, and this break happened exactly in the pattern that I don't want to see for the dollar. And that's, well, I mean, you don't want to see if you want things to go well. Dollar going up is not usually a good sign. And so it broke above the weekly average, came retest, and seems to be holding. So if we actually get a high above a new high above 108, 108.18, let's call it, then we are in another move up to the top of this channel. um, and that's not good because we have all this support down here that we just haven't been able to crush. I mean, we really bounced off really hard off of that. And one thing I noticed recently was that this period of time is about 700 days. It's almost like
Even in that last range there,
sorry.
even in that last range there.
Yeah, it's about 700 to 800 days, and
Yeah,
it's usually
700 days.
about yeah, it has to do with like uh, funding cycles that happen throughout the world, and these things sort of like coincide uh, with options expiries. Another thing we talk a lot about. So I believe over here, this peak over here happened in March OpEx is one of the major OpEx, and then we had another peak. This peak over here happened in September. September and March are the two OpEx periods that are the most significant because the two other ones, one happens in summer where things are quiet, and the other one happens in December where things are quiet. So often September and March, and around those periods of time is when you get big crashes or big liquidity squeezes. And so we're quietly heading towards the next one in February, March of this year, which is, to me, I'm hearing the fuse on the bomb ticking that when we get there, we're going to get another huge rise up to the at least at the top of this range, which coincides with what we're seeing here in the bond market, um, where you'll let me know if it's a little bit too crazy here, but there's two things I want to point out here, Mike. First, this if we take a look here, this jagged line here is the federal funds rate, and it's right now above the long term rates, and it's coming down. Well, when that happens, the other times that has happened is over here in the global financial crisis 2007 and the dot com bubble in 2001. So it's not usually a good sign when the Fed funds rate is above long term rates and all of them are falling together, and then one follows faster than the other. And at the exact same time, volatility is low. So down here we have the VIX, which is low. VIX is down to 13, which is still relatively low. We have the Move Index in purple here that's fallen down to 82. We have the NSCI, the financial credit that's falling. So it's like it's the calm before the storm. It's the sort of thing that really really worries me, because it's when things like this break, we don't exactly know where it's gonna pop up, right? So we don't know if it's gonna be in emerging markets. We don't know if it's gonna be within domestically, within the housing market, within tech stocks, within Bitcoin. We don't know, and I'm not seeing the signs yet that's telling me where things are gonna break, but it definitely looks to be within the signs are certainly starting to bubble within the markets. Have you been seeing anything that's like worrying you? I know there's no real shortage of sign like doomsdayers if you want to look for doomsday stuff, but has anything popped up on your charts at all that makes you wonder, like, hey, this is suspiciously volatile or suspiciously quiet?
I mean, like I said, right now things are suspiciously kind of quiet, with overall ATR down on SPY as well as the VIX being pretty low at the moment. The range is getting tighter and tighter. Price action is a little bit tighter. Even futures markets are pretty quiet on a day to day basis. We've got some nice moves on NQ, but the ES futures are tradable. Their ranges are fairly tight. It's fairly predictable right now. So usually in those calm moments, that's when I'm always trying to prepare for big spikes in volatility. I think another consideration that I'm making right now across markets is just keeping an eye on price to earnings ratios. And one of the metrics that I try to keep an eye on is the Schiller PE. We had this big uptick in October of 21 to a PE of 38. And if we go back to the charts of October 21, excuse me, just pulling back that chart, once we had reached that point of the average PE being somewhere around 38, 39, there was one more blow off at that point in December of 21. And then that was a big pullback for us, all through the next year into December of 22. So I am keeping an eye on the Schiller PE. When we had that pullback in markets through 21 through 22, the PE went all the way back down to about 28. And we've since then risen back to 38.55 as of today.
Hmm.
So that Schiller PE ratio just tells me that in general, equities are a little bit overpriced. We'd like to see them closer to a valuation of around 15 on average. That's been sort of the historical ratio. If we look at the average PE over the entire history of the S&P 500, it's about 17. So right now to see it at 38.55, it's a it's a fairly high number. It's one to keep an eye on. And if we're in these low ranges of volatility, I'd be expecting breakouts here that cause excitement. One other thing that I always observe, especially in trading accounts, just watching traders trade in general, and having been around trading for a long time, when volatility starts to contract like this, people usually start to pull their stops a little bit tighter, and they start getting used to this new tighter average true range of price. And I just think that that sets off stops faster, and then you end up seeing this big feedback loop. So where normally you would have maybe put your tight out your stop a little bit further out because you needed to account for volatility, if everybody's trading inside these tight ranges, you start seeing stop losses get triggered pretty quickly. As
That's very interesting. So that whole sort of thing, like where people want to get into the trade, but then they don't want to give back too much to the market, so they trail their stop.
Yeah, a little bit, or at least the stops in general are just much closer to your to entry prices. So on if there's any kind of volatility event that spikes here, just a lot of stop losses get hit right away, and that triggers a little extra volatility in markets.
Actually, I haven't asked you when you're setting up or when you've seen people set up automated trading strategies. I'm always curious if they change their input settings based on macro events that are happening. Like if it's around certain periods of time of the year, or if certain events are happening with governments or fiscal spending or anything like that. Do do you have to adjust an automated strategy to then account for that? I know there's some adjustment like over volatility events, FOMC meetings, CPI reports, whatever. But if the macro environment seems to be one way, if the economy seems to be one way, would you change your settings in a automated strategy?
I mean, I do personally. I have a volatility adjusted stop on a lot of my strategies. If there's any kind of trailing stop, the starting point isn't just a fixed number; it's adjusted relative to volatility. And if I'm not adjusting my stops, if it's already a fairly wide stop that's accounted for historical price action, then I'm just adjusting my position size accordingly. So that way, the risk is relatively flat over the long run, right? If volatility starts to increase, position size comes down, the risk reward proposition is roughly the same.
So I haven't been having this issue where I'm down the VWAP rabbit hole that you sent me down some months ago. I feel like I'm never going to get out of that. And so in consolidation ranges, I can I wonder if I should pull it up. In consolidation ranges, I use the daily VWAP in order to just scalp trades, 1%, 2% throughout the consolidation range. Because I'm in crypto and I'm using 50x leverage, well, it's pretty good, can be pretty good returns if that's there. And then I have this other strategy where I'm trying to capture these trends when the breakouts happen. And I'm finding that sometimes I need to be aiming for the daily VWAP, and sometimes I need to be aiming for the weekly VWAP. And in major events, I need to be aiming for the 1 month VWAP in
Mm.
order to make sure I don't get shaken out of trades. Because let's say there could be a bullish trend, and I'm still in a bullish trend, but it might, there might be one or two candles that really wick down all the way down to the weekly VWAP or some 3 month VWAP, and I would get stopped out of the position. But if I were just to leave it, well, it would rebound and it would get back in. And I'm curious if you have any advice how I could deal with this, because my instinct is to be like, well, I should just remove my stops and just allow the account to get liquidated and just, I don't want anything to get me out of the trade. But then at one out of every four times, it does actually liquidate the entire account because it moves so drastically and I get out of the position. Do you have any advice for something like that?
I think you're kind of describing the second part of the adjustments that I make with strategies in general, which is more of a position sizing adjustment based on volatility, so that you don't end up getting stopped out so early or getting liquidated so early.
Right.
If you're well away from your margin requirements, you got a lot more opportunity to let the trade move.
Hmm. Well, I'm trying to work out something because I really want all of them to work. I find that if I'm paying attention to the trade, like I can tell if I should, human beings, we could read more into the chart than what our algorithms could figure out. And I could be like, okay, no, I should really get out of the chart. I'm being greedy right now. Or other times I'd be like, no, 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 let me add more margin to it. This should go. But the letting it on its own, I find myself lying awake at night going, should I have closed that position or should I add more margin to it? Oh, it's such a
What
terrible feeling.
what I find interesting lately, and this is definitely a tangent, is the screen share functionality that you can now use in ChatGPT. I would be wondering how ChatGPT might be an interesting guide to your approach here to think through what it sees on the screen with you. I'm surprised that you haven't been using this more for that exact function to give it a sense of what you're trying to trade and watch the chart change and get a sense of what ChatGPT might be saying in response.
Well, because I find I can always make an indicator that tells me the opposite of what I want to hear. Like I also go, okay, I have 10 indicators here, and 9 of them say go ahead. And then I'll make another one that seems to correlate very nicely with the moves, and then it'll say no, you should do the opposite of what those 9 do. And I just the more I look for information, the worse it seems to go, which is why the VWAP to me has been so unbelievable because I can almost get rid of almost everything else. If I just had the VWAP to trade, like if I had one indicator I had to use, I would just use VWAP. That and looking at the dollar tells me essentially where the trend is going in any liquidity asset, especially like Bitcoin. So
Sure.
yeah,
I guess to that point though, it's pretty difficult not to get chopped out sometimes, especially when you're trading long ranges. But
that's it.
it's an inevitability at some point.